Hello guys, in this video I will try to explain 10 secrets of investing in stocks. You know, a lot of people, when you go online, you find a lot of criteria about companies, but there are other things that are more important in investing than to check the company fundamentals. Yes, it is essential to check, because without checking, you can't invest in a company without knowing its fundamentals. This, we are not dealing with it right now. What we are dealing with is other secrets that are neglected, and if you neglect these 10 secrets, your investment will be a loser. Okay, so let's go one by one and check. So the first one is never buy one stock. So the reason for that is very simple. Now, if you buy one stock, you have what we call high risk. What does it mean, high risk? It means what if you invest in one stock, in one company, and you think it's good, and then you see that the stocks plummet. It means it's going down, and you lose 10%, you lose 20%, you lose 30%, 40%, and you are staying in the same company. You think and you are sure that it is a good company, but in real it is not. Now, the main thing you can see here is that when you are losing money, 10%, 20, 30, 50, 40, 60, 70, and then maybe one day this company will be bankrupt. So what is the thing? The secret here is never buy one stock. This is the secret. Buying one stock makes your investment in high risk. Now, someone else say to you, okay, what if the stock is doing so good? Okay, you can make a lot of money. Yes, you can make a lot of money, but are you sure that when you buy a stock, it will be going up? Are you sure 100%? Okay, there is no one who is sure in the market, because the market of any company can go down, and one stock is a high risk. Now let's go to the second one. Buy multiple stocks. Buy multiple stocks. This is the right way. Okay, the right way. Why we buy multiple stocks? Because it reduces risk. It reduce risk, and this is what we want to do in our investment. In our investment, we want to reduce risk. We don't want to go ahead and make a large risk. Understand that the money that you have and you want to invest, you save it for many years. There are a lot of people that have let's say 50,000, 100,000, 200,000. They have a lot of money and they want to invest. So they just go let's say online, or a guru online, or they watch TV or those analysts, and they say, okay, this company is good, just put all your money and it is a success. Now, you put all your money in one company, and then after a few years, you will see that the price is declining, and you see that the stock is going down and down and down, and you begin to lose 10%, 20, 30, 50, 60, 70, and then one day, your company, you don't find it in your broker, and maybe the company is bankrupt. Okay, so never have this idea to risk all your money in one stock. This is a high risk. Okay, now on the opposite side, if you buy many companies at the same time, okay, you reduce risk. If even one which goes down, you lose 10%, 20%, or 30%, it's okay. Why? Because the other companies, when they are doing good, they make a balance, and you always, most of the time, you will have a good investment in the future. Okay, so let's go to number 3. Number 3 is diversify your investment into sectors and industries. Okay, now why is that? Why you should always, you heard this, you hear these words, diversify or diversification. It is also to the same thing as buy multiple stocks, which is reduce risk. Now, why is reduce risk? Okay. Now, if I give you an example, a clear example, have you seen, for example, energy sector before? All energy sector collapse. Okay, it collapse. For example, a barrel of oil, just an example, it was $150, and then it goes, let's say, right now to $65. You see, okay, all this energy sector collapse. Now, let's say you like energy sector, you like it, and you always buy stocks from there. What if you buy like 2 years or 3 years ago, all you put $100,000 or $200,000 into an energy sector, and then it collapses? It means that you lose 20% or 30 or 40 or 50%. Although the other sectors, all the sectors are doing good. Okay, so this is the problem here. Okay, so when you put all your money into one sector or one industry that you like, for example, you like drug companies, you like banks, you like insurance, you like whatever you like, and you are always interested to buy on those energy sector or another sector. Okay, understand that the risk is high, because the market, sometimes some sectors are doing good and one sector or 2 or 3 are doing bad. Okay, so if you put all your money in one sector and this sector collapses like the energy sector, understand that you lose a lot of money. So let's go to the 4th one. Okay, now number 4 here, never average down. So for those of you who doesn't know what do you mean by average down, okay, so it means simply to buy more when the stock is going down. Okay, so let's take an example. Okay, let's take an example. Let's say the stock or the company that you bought here is going down by 10%. Here, you buy more. Now, it goes to 20%. You buy more. It goes to 30%. You buy more. Now, what are you doing here? You are what you call averaging down. Averaging down, it means adding shares to a loser. Now, for me, this is the worst case you can do in your investment. Why you are giving money to a loser? People are maybe shorting this stock. Mutual funds are selling off this stock. So why you are adding to a loser? Because when you add more and more and more, you are getting more and more loss into your money, and this is not good at all. So never average down. Okay, so number 5, buy more for the good ones only. And this is my strategy, okay, for investment. I buy more if the stock is moving better and better and better. Why should I Why should I add money to a loser? Okay? This idea. You should try to understand it very much, because the people, when they are investing for many years, let's say they put $50,000 in one stock. The stock is going down. It means $50,000 is going down to $40,000, to $35,000, to $25,000. It's going down, and you are putting more and more and more money. Okay? You think you are so clever, so smart, that the market will go up again and then you can recover your money. But unfortunately, some stocks never recover back. And believe me, some companies, they were $400, $1,000, and now they are 10 cents or 20 cents. So understand that you are doing a big mistake. Okay? So let's go and continue so check number 6, check their fundamentals each quarter. Now, why I say each quarter? Quarter, it means each 3 months. Okay, so each 3 months, especially when we have the earning date. Okay, so when the company announces the earnings, it means what has the company made as profits and as earnings. This, you have an idea that the company is still good, it has still good fundamentals that you buy it for, because you have been searching for companies that are good, and this company, according to the fundamentals, it means earnings and profits and debt and all other stuff. You find that this company is good. That's why you buy it. Now, each 3 months, when there is the earnings, try to see if this company is still doing good or better, and it increases the profits, it increases the earnings. And look, even for dividend, some companies, they increase the dividend, means they are doing so good. Okay, so let's go to number 7. Check their earning increase if you get dividend. This is another thing I want to speak about. Okay, so check the earning increase if you get a dividend. What does it mean, this? Try to see, there are a lot of companies that they give dividend. Each year, 2 years or 3 years, they increase it. For example, they give $1 each year. Okay, or let's say 1% or 2%. Okay, try to see if the other year or the following year they're giving more and more and more dividend. It means generally, when you think about dividend, if a company is doing well, it can give a dividend. It's cut from the stock, I know, and you should know that it is not from the company earnings, it's just from the stock itself. But they see that the company is growing good, and they have made a lot of money, and each quarter you see that there is an increase. And this is how big companies, they become bigger and bigger and bigger. If a company each year it shrinks, it means the morning that comes, or the profits are less and less and less each quarter. What does it mean? It means that this company is in trouble. Okay, and then you see that the stock price is going down and down and down, because mutual funds, when they see that this company is not doing good for 1 year, 2 years, 3 years, they take their money from this company. That's why you see companies go down. Okay, and I have shown you an example of the Dow Jones, which is the GE. 2 years ago it was $33. Now it's $14. Now what does it mean? It means that mutual funds are selling off and the price is going down. It means that this company, fundamentals, is not doing good. Although they make profit, but it's not that good. Now let's go and check number Number 8 here. Never listen to analysts. This is a big thing I want to show you in this video, okay? Because understand what is these analysts are doing in the market. They are not just staying there, giving their serious opinion. Who pays them? Okay? They are just paid to give you an advice or to give you an opinion. That's why when you go to analysts, you find them, some they say to you sell, others they say hold, and others maybe they are neutral, and others they ask you to buy more. So are you going to follow these analysts? You should be your own analyst for your own business, for your own investment. Even if you don't know, the price will tell you. Okay? If a company price is going down and you are telling me that it is a good investment, I will never buy. Now, why I never buy this company? Because the price is going down. I will never buy until the company fundamentals change and the price will change. Now, when the price changes, it means there are some mutual funds are buying, so I can buy from the beginning. But a company that lost 10%, 20 or 50 or 60%, the stock was $60 and now it is $2, and some people they ask you to buy this company because it's good investment, tell them it's okay. Okay? $60 to $2 and it is a good investment. So this is the opinions that you get is most of the time these analysts are paid. When you see TV, these people are paid. Any word they tell you, they are paid. Understand that. They are not just staying there to give you a free advice on investment. Anything that it is told in TV, it has someone behind giving or paying money. Okay? And most of the time, for me sometimes, I just for fun, I go to analysts and I see what they are talking about. Okay? For example, before, in 2012, when Facebook was going down, and then it has been going up, but the analysts say bad about Facebook. Now, go now and try to see what these analysts are saying about Facebook. When it is over, and mutual fund have bought Facebook from $17.55, okay, and they have been buying until it reached 160, 170, 180, and then the analysts come to us, oh, Facebook is good. Okay, in 2012 you say that it is bad and it is never an investment. So you see the change. So try not to listen to people what they say about investment. Try yourself to learn by yourself, and most of the time, if the company has good fundamentals, the stock is going up, it could be a good investment. So let's go back. Now, number 9, choose and search for companies by yourself. This is one of the biggest secrets of investment. What does it mean? Why I say to you, you should search by yourself. Okay? Don't get influenced by the opinion of analysts. Try to search. If you don't know how to find good companies, you should see some books and find some criteria. Most of the time is profits. Is this company profitable? Yes or no? Does it make money? Yes or no? The competition. Is this company competing very well with the industry? It means with other companies? Is it good in the market? Is it making money? Is it expanding? Okay? So you see, most of the biggest companies, they were small, but they go bigger and bigger and bigger. That's why the people, they buy these companies. Okay? They buy because they are going bigger and bigger and bigger and bigger. Not a big company, they invest in it, and then it's going down and down and down, and you are going to buy more, to buy more, to buy more for a loser. That's why the best thing you can do is search by yourself. Make an investment, a portfolio of investment. Okay? If you don't know, you should study, you should read books. Okay? For me, I have only one training level 16, how to invest in dividend stocks for USA stocks. I give a lot of information about tax, because some dividend companies are not the same. Some you get taxed more than other companies. So be careful when you are doing an investment with dividend. Okay, try to see my training, which is training level 16, to get more information. I'm speaking here about USA companies. If you are from India, from Europe, or I have no idea about tax in your country. But for USA, you should check my training, which is level 16, how to invest in dividend stocks. This gives you an idea about a lot of things that a lot of people, they don't know about these companies. Sometimes you buy a company, okay, and then after many years you find that you are paying too much tax and you don't know why, and other people are choosing other companies and they are paying less. So there is some tricks here, so you should see that. Okay, so let's go to number 10, which is the last one. Replace losers if their fundamentals change to worst. Now, understand that, let's say you have 10 stocks for many years. You find that one stock is doing so bad, it's going down. You bought this stock at $30, now it is $15. So are you going to stay until it becomes $1 or it becomes bankrupt one day? So try just to see some risk. If you reach that risk, try to change it. Or you can reduce the shares and buy another one. Buy another company. Okay? Because a lot of people, they don't understand how companies are working. Some companies are becoming bigger and bigger and bigger. They are very well known. For example, if you see Apple, it's going bigger and bigger. Google, Facebook, and other companies that becomes so big. It's just because all the people who understand investing, they find these companies, each year they are making more money, more money. They're becoming bigger and bigger and bigger. That's why the people, they like these companies. That's why even Warren Buffett has bought Apple, for example. Why he buys Apple? Because he see something that it is unique about Apple, is the smartphones. Coca-Cola is about the cola itself. Okay, they sell for all the countries of the world, and all the countries of the world, they know Coca-Cola. Even in the jungle in Brazil or in Africa, you find some people who are naked, but you find drinking Coca-Cola. So it's very good. It's very good to hear that. So you see how companies can reach all the people in the world. This is the companies that people are investing in them because they make more and more money. Okay, so this is, as I told you, 10 secrets of investing in stocks. Now here, I'm not speaking to you about how to search for these companies. It could be another video. Okay, I will make sure to add as much as criteria as I see it, but to try to revise all these 10 secrets. And if you have something or you have another opinion, please share it with us on the comment section. Or if you have a special question about my training, please send me an email, as you can see, and I will be happy to answer all your emails. Thank you very much, and see you next day.